Well, it's 11:01 and time to get the show on the road. It's a more normal show this week. So we've just got the media news, and then we've got Gauld, who's the manager of Standard Life Private Equity, coming on. Talk a bit about that fund and what's going on with the private equity market, which is should be interesting. So relatively quiet news for week for news this week, actually. But three things that I pulled out to talk to you about. First of those is Atlantis Japan, which is the Japanese small cap fund. Then I thought I'd mention what's going on with SQN Asset Finance Income, which has got a continuation vote coming up next week or the week after. And then Primary Healthcare Properties, which is quite a good fund. But we'll explain why in a minute. So to start off with Atlantis Japan. So first off, you can see there's a 90 million market cap. So as I say, it's a reasonable size, but probably a little bit too small. It's also the cheapest of all of the Japanese funds. What I've done here is I've put the Japanese small cap funds, the 5 of those, there on the top of the table, and then the 6 mainstream Japanese funds underneath, so you can compare the two. So as you can see, this is the one that's on the widest discount. Now, part of the story with this is dividend yield, and we have a perennial problem with Morningstar. They seem to get these things right and then they get them wrong again. At the moment, they're showing that it's got no yield. That's not true. It is distributing capital as a way of trying to get its discount down. And as we can see quite clearly here, this isn't working. So we'll talk a little bit about why it might be. On performance grounds, if we look to something like 3 years, 5 years, it's not too bad. I mean, actually, say every year, it's the second best performing small cap trust. And actually, small cap's not been doing too bad either relative to the large cap ones. And there have been some quite disappointing performance in the large cap funds, actually. So things like Baillie Gifford Japan hasn't been doing very well. CC Japan Income and Growth, losing money. Schroeder Japan, losing money. What I've decided to do is do a little sort of thematic thing on here. So what I've done is I've written an article about JP Morgan Japan for Citywire this week. So that will be coming out Monday, Tuesday next week. And I'm writing an article now on Baillie Gifford Japan, which will go out with the weekly tomorrow for you to read. And I thought just we'd talk about Atlantis Japan now. Japan's quite an interesting story. They obviously got hit by COVID, same as everybody else. But they, after some initial criticism, they seem to bring it under control reasonably quickly. So they got criticised for not testing enough, especially relative to Korea next door. But what they were very good at was the track and trace, controlled the spread of the virus that way. And that's allowed them to reopen the economy. They weren't, for some legal reason, they weren't allowed to do full-on lockdowns, but everybody's quite compliant. So they all wore masks and they all stayed at home and socially distanced. And that seemed to work quite well. So I think it's ended up with about 900 deaths, which compares very favourably with some other parts of the world, including here, obviously. Anyway, so back to Atlantis Japan again. As you can see, they've never really got the discount under control. They used to have a sort of informal or semi-formal discount control mechanism, but it wasn't targeted to bring the discount down to zero. I'm tending to think now that if you don't do that, if you don't try and operate it around close to zero or within sort of 5% or something, it just doesn't really work. You just end up shrinking the fund. They were getting frustrated with the fund shrinkage, and that was the reason that they switched to this idea of, well, we'll try and get the discount down by paying a high dividend. But when markets fell out of bed with COVID, its discount widened and it hasn't come back again, as you can see here. So this is what I was saying before about the dividend. It's paying out 1% of NAV a quarter. This is sort of standard format for lots of funds now. This is what they're doing. And it just really comes down to a matter of the hassle involved of if you want to take income out of your holdings, Do you want to go through the hassle of selling a bit of them every now and then, or do you want them to effectively liquidate part of the capital and pay that back to you, which is what they're doing here? And I'm just, for me, the jury's out. I'm really not convinced that it works. Some funds it seems to, some funds it doesn't, and here it definitely hasn't. Because it hasn't had, well, because the NAV's fallen over the past year, the dividend's going to fall as well. So this is the other problem with paying this fixed percentage of NAV idea, is that if you're reliant on the income, that you don't get this steady uplift and maintain dividends that you would do with a normal kind of income fund. So it's just something that's to bear around. But what I would point out here is that actually, if you look at the long term, so since it started, this is actually a really quite good performing fund. And it is true that most of these Japanese funds over the long term have done very well. It's a sort of market where if you're doing stock picking, you can actually make a decent excess return. The managers say a lot of that is down to the fact that stocks aren't very well covered. There's an awful lot of them, and there's not that much research out there, so things do get mispriced and forgotten about. And fishing, especially in the small cap area, you can identify real bargains. And also you can end up buying things that are genuinely changing for the better. So it's not just investing in Japan PLC, you can actually invest in companies that are growing and developing new export markets and things that are capable of outperforming. So that's how you can achieve these returns well in excess of the index. And this fund has been doing it, and so that point it kind of ticks the boxes. And I just think it's missing the message here by trying to focus on income as a way to hook people in. It should really just be pushing the strong performance. Anyway, that's that one. SQN Asset Finance Income has been a bit of a horror show. In fact, this whole leasing market is pretty dreadful now. And because we've seen all the problems that the plain funds have had, and I've talked a bit about this before. This one, I thought it would be quite a good investment when it launched. The idea that you buy an asset and then lease it out. If the lessor can't pay the lease payments, then you've always got the asset. And so it seemed like it should be a fairly safe thing to invest in. I think what we have to conclude is that some of the underwriting they did when they were analysing what they were going to invest in was clearly flawed. They made some really quite major mistakes with this, and that's really why people have lost faith with it. You've seen that the obviously still got C shares and ordinary shares. They've never got to the point where they can merge those two pools, even though the C share pool is actually quite old now. I just don't think that either one wants to be mixed up with the other. But we're coming to a stage where something might happen. On performance grounds, you can see that the ordinary share portfolio has actually been losing money in NAV terms. It's actually been writing things down. That's not really true of the C share one yet, but it may be in the future, and that's really why it's trading at a big discount. They've shifted the manager across, and this may be the good news story here. So Dawn Kendall, who's the manager of SQN Secured Income, has moved across to something called KKV, and she is going to take a good hard look at this and try and sort it out. She wasn't responsible for what's gone into the portfolio here. This is some of the same team, but not all of the same team, and so we hope that she'll be able to pull this around. But in terms of sorting out what's in the portfolio already, this is going to take time. So you can see the split of assets they've got in there. Classic debt fund, they never actually tell you who the real borrower is. Oh God, there's some of them we do know from history. They've had a problem with their AD anaerobic digestion plants, as that's been quite well flagged. And that's one of the things that's top of the agenda to sort out. But there are all sorts of other things going on here too. So this is what they said in this most recent statement. Oil price, COVID-19. but there's worse things underlying that, really. So if you just look at some of the things that are in the portfolio, a big chunk of it is in shipping, and obviously if you've got a decline in world trade or a decline in things being moved around, and they're underutilised and shipping rates fall, and that's true of this portfolio. And they don't have top-notch vessels, so there's a bit of sort of second-tier conflict of assets, so that's going to affect any kind of resale value that they get for those. They've got quite a good business doing remote operating vehicles, but the customers for that were really all up in the oil fields, and that's been hit quite hard, obviously. They've got a hospital in the US that can't perform elective surgeries, so its income has been suffering, and that's just purely COVID related, and you'd hope that that would come back again. But clearly the hospital is not as well capitalised as it could have been, and again, that's the sort of industry you think would be quite secure. Ancient history was this Soneva solar cell manufacturing plant in the States. It's the thing that one of the things that sparked the trade war with China. The cheap Chinese imports were undercutting US manufacturing, and so they slapped tariffs on those. In theory, there's a way for them to get some of the money that they lost back by payments from this pool of tariffs that's been collected. That still hasn't materialised yet and is dragging on, and any kind of political change might actually kill that. They had a thing called Snoozebox, which was sort of porta cabins that you could hire out as event spaces. Obviously, with events now suffering, that's not doing very well either. They got a portfolio of residential boilers, which again, you'd think if you get the underwriting right, this should be quite straightforward business. But they're now saying that some of these boilers are coming to the end of their lives maybe sooner than expected, and they've got some potential bad debts too, so they're a bit worried about that one. And this goes on, I could keep going on this, but you can see that individual cases, there's just too many things going on with it and not enough cushion built into the ability to recover the money from when the lease runs out, or when the lease goes wrong. So 60% of the ordinary share portfolio is distressed or distressed. 30% of the C share one. They've had to make chunky provisions. This is what came out this week. Distressed means that there's a real problem, that there is something that they're going to have to start renegotiating and try and work hard to get the money back. This is all really kitchen sinking things. They're basically laying out exactly the scenario as it is, and asking shareholders to give them the benefit of the doubt and vote for continuation, which is on the 16th of July. And if you do that, then there's a vote for each of the two different share classes. If they both pass, they'll work very hard to try and sort the portfolios out. And you'll be able to judge how that's going and then have another vote in November 21. I think actually shareholders should probably go down this route. It's been a bit of a disaster, but I think it's worth giving Dawn the chance to see if she can turn things around. She's going to be slightly hamstrung with what's going on with COVID, but as we recover from that, that might help a bit. And then if they can demonstrate it, then they've got an ongoing fund, but I think the jury's still out. We'll wait and see. But what it's not worth doing is trying to fire sell the portfolio in the current market environment. So that's why I wouldn't vote against continuation now. You won't get any more money in it. Right, so more of a good news story now. But one I thought was worth highlighting just because we talked about Civitas last week, and the idea that you've got a portfolio of property which is doing something useful and is backed by revenues from the government. And Civitas is trading on a 2.9 premium now, I mean, being at a quite chunky discount, which is obviously great, and a 4.9% yield, which, as I pointed out last week, is good when you think that it's backed by government revenue. But primary healthcare shows you where these things can get to. So it's doing something similar but different in that its portfolio is backed by GP surgeries. It's trading on a massive 36% premium and a 4% yield. So it's not beyond the bounds possibility that something like Civitas could get there. It's a very chunky fund, £2.5 billion now. What it did is it took over Medix, or well, it was a merger, built as a merger, which means that it's the preeminent player in this market now, with 488 properties. I think it was at the end of December. It might be slightly more than that now. 90% of its income comes from the government, and it's operating in the UK and Ireland, so some nice safety restrictions. Same thing as Civitas, long leases, fairly efficient. It's got a bit more debt, which you think would make people a bit more nervous, but 45% loan to value or 46% loan to value. It's still relatively safe when you think how strong the covenant is on the property. And you can see where it's invested in, so GP surgeries, pharmacies and that sort of stuff. This, I think, is really why investors love it. It's this steady uplift in the income going all the way back to 97. And that is covered by earnings, which is, I think, extremely helpful. It didn't used to be the case. That's really only happened in the last decade. This cover has been slowly building, and for the last few years, it's been fully covered. And they're going to pay out fully covered dividends from now on. They are getting rent increases, but they're not huge. I mean, this is just a steady state, nudging income up type thing, not rather something very exciting. But they are able to grow and expand and add to the NAV by doing new developments. So that's the steady part of the portfolio now. There's one here, I think that's in Ireland, that's we're working on now. There's an awful lot to do, as it says here. So half of the GP surgeries probably need some kind of updating. Some doctors will go together and do it themselves, but it's better to get something like primary healthcare involved and get them to pre-fund it. So because they've got so much to do, they've been raising more money. They regularly come back from the market. And it's incredible because people love it. Even on that massive premium, they opened and closed a placing on the 9th of July. Wanted 120 million, got 140, and that money came in at 35% premium. It's really quite encouraging. So that's what Civitas could get to, but we will wait and see. Now, so I will shut up for a bit, and I'll just bring in Alan. Hi, Alan.
Good morning, James. Thanks for having me.
Good to hear from you. What we're going to talk about is obviously Standard Life Private Equity, which is one of our clients, been a client for ours for a while. But I figured, because we can't guarantee that there aren't people here that haven't heard the story before, it might be worth just running through a bit of the sort of short-term history of the fund, what it does, and how it's been doing, and maybe we'll talk about how it's been doing, particularly with COVID.
Yeah, no problem. Well, firstly, on me, I mean, I've been 11 years in the team. I've been involved with Standard Life Private Equity Trust, or SLEPR as we call it, for the last 3 years, and this has been a year as the lead manager. So, I mean, what does SLEPR do? Well, it is principally a fund-of-fund private equity trust, invest in private equity funds essentially, and co-investments, which are direct investments into private companies alongside private equity managers. It was established in 2001, so it's got a long track record, and really it's about giving investors access to a focused group of private equity managers. It's high conviction. It's our view of the strongest managers in the private equity mid-market space. Over 70% of NAV, for example, is to 17 core managers that we backed in their latest fund, and almost 50% of NAV is in the top 10 funds. So it's reasonably concentrated by fund. All of these managers we have tracked and monitored for over 10 years. They're institutional firms. It's not two people and their dog, sort of institutions. It's very, very institutional. And then we believe being focused allows us to pick the best. Over 70% of our picks, for example, in the last 10 years and since inception, are above the median benchmark of private equity funds. I think everyone thinks that they pick the best, but our team has been around really since the 1990s. Our senior team has, on average, over 22 years of industry experience. We've made over 1,000 fund commitments as a team in private equity. So we think that sort of experience and credibility serves us well. Now, I'm going on a little bit, but why don't I just turn it a little bit to the fact that whilst we're focused and conviction-based at the fund level, as an investor in the trust, you get access to over 400 private companies. Only 8 companies equate to more than 1% of portfolio NAV. So you get this sort of conviction approach, but fantastic diversification by country, sector, maturity as well. And then the last thing I would say about the trust is that it is largely European focused. You should think of us as, roughly 80% Europe, 20% North America. We do have a team in Boston, Massachusetts, of around 15 people, and they have an exceptionally long track record as well, and they pick off the best mid-market opportunities in the US selectively. But yeah, really the big focus is more kind of European mid-market. I'll pause there and allow you to jump in, James.
What sort of companies are they? I think because people have sort of slightly pejorative views about what private equity does and the sort of things it invests in. Do you want to sort of just explain the sorts of companies that your managers are buying?
Yeah, no problem. Maybe we can go through a few examples as well, if that would be helpful. I would say that private equity, this has been we've gone through quite a long bull market, and really, look, private equity managers have pivoted to more resilient sectors in I would say in the past 5 years. So really, we're starting to see real prevalence of tech, particularly software coming to the fore, healthcare, sort of medical technology companies. I think private equity has a reputation around consumer and for example, in the UK, the casual dining sector, for many years, private equity was a big investor there. But we've seen them move away from those sort of industries and move more towards e-commerce and omni-channel type businesses in that area, more staple businesses. So there's a real selection. If I maybe just talk you through some of our top 10 businesses.
Yeah, sure.
So the first one is Action, which many of you will be familiar with through 3i. We've been a long-term investor there through their funds, 3i Eurofund 5 since 2011, I think. And then in the recent process, it was a liquidity process run by 3i. We took some money off the table because Action had performed so well, it become outsized in our portfolio. And it was around 8% of NAV. We've reduced that down. It's now our largest exposure, 3.7% of fund NAV. And when we first learned about Action, 9 years ago or so, we saw it as a consumer discretionary business, a sort of discount retailer. And it has evolved, I think, an awful lot. And it's more supermarket in terms of its business model now. And we've seen that through the tail end of lockdown. It had pretty much all of its stores open. And really, we've seen a resilience there in that business that perhaps we weren't expecting when COVID first emerged. And who knows what's going to happen in the second half of the year, whether there'll be a re-emergence of COVID. But there is a strong conviction here that this business will grow this year. It has grown every year since its inception. So it is just one of these truly remarkable private equity success stories.
So it's been quite a profitable one for you. How much money have you made on it?
It's at the company level, it's hard to say. On our original fund commitments, we made 30 times the original money. But we did do secondary transactions as well in the fund. We bought the fund from other investors. When the fund was valued, it was going through a difficult period. And so in terms of those secondaries, it's in excess of 30 times. It's far in excess of that. So it is truly one of our great success stories, and private equity's great success stories.
Cool.
And then if I quickly, don't want to dwell on this too long, and we can talk about COVID-19 and how it's impacting, but TeamViewer is one of these businesses that's actually positively benefiting from the current situation. Now, this is a business that Permira, the sort of London-based private equity firm, bought several years ago. It actually listed the business on the Frankfurt exchange at the tail end of last year, and it's been doing record sales, obviously, with distance, people working from home. This is the software that allows them to do that, and so the share price has reflected that, and hence it's become one of our largest positions, and that's valued about above 10 times original cost right now. And then if I briefly just give you a sense on the others, Mademoiselle Dessert is a producer of frozen pastries. Obviously, stockpiling helped it on a temporary basis. It's a resilient business.
This is one that you actually made a direct investment in, is that right? That's
our first co-investment since we introduced co-investments into the trust.
Sorry, pause here. Sorry, just to answer your question. No, there aren't any slides that Alan should have on the screen, so I didn't ask him to do those. So just made that clear. Sorry, go back to you.
Yeah. So yeah, we feel that's quite resilient. There's obviously cafes and restaurants aren't open, but supermarkets very much are, and there's still sales through there. And then there's a mixture, really, in terms of the rest of the portfolio through healthcare businesses, other staple business, consumer staple businesses, and industrial businesses. But actually, these two industrial businesses, there's one called CID Lines, which does hygiene solutions for the agricultural sector. So again, hygiene being very important right now, it's doing well. And a PVC component producer in Benvik, which again is performing well through the crisis. So we're feeling pretty good. Like, we went through our top 50 companies, which are around 39% of portfolio NAV, and we feel that over 3/4 of those companies, either COVID has had a positive impact or a limited or temporary impact on a negative basis. So we're feeling pretty good. And in all of the top 10, none of them are severely impacted. So far so good, but we do appreciate that this could be a lengthy situation, and we remain cautious.
Yeah, fair enough. One of the things that we should probably address is the sort of structure of the fund and the commitments that you make and the cash that you keep back and trying to reduce the cash drag, and all of it, which is a peculiarity of running these private equity funds. So you make commitments to limited partnership funds well in advance of them actually drawing down the money from you, don't you?
That's right. We've essentially run an overcommitment strategy since inception. So I appreciate that can be quite scary for some investors when you see the amount of outstanding commitments that we make. But we have great experience of doing that, and that allows us to be most efficient in dealing with funds. Funds typically have a 10-year life, and the majority of capital is drawn over the first 3 to 5 years of the fund's life. So if I make a 10 million commitment, for example, then I will be drawn more than likely 2 million a year for the first 4 years, and then another 2 million will be drawn at a lower rate for the remainder of the fund life. So it's about understanding that and planning for that and doing an awful lot of modelling. At the moment, we have outstanding commitments of just over 450 million. I think 458 was the last announced numbers. We estimate that around just under 70 million of that will never be drawn. That's just a peculiar situation in the private equity market that they don't always get to 100% drawn. And at the moment we have 58 million of cash. We have deferred consideration coming in from a secondary sale equating to 15 million. We have an undrawn credit facility that we've just extended at the tail end of last year. That's 100 million. So we have around 170 million of resources to cover, we feel, about 390 million of outstanding commitments. And that is prudent because the fact that these outstanding commitments are drawn over a longer period of time, and we'll receive distributions from the funds as they realise portfolio companies.
Yeah, okay. And what's the experience been the last sort of few months? Have people been stepping up buying because things are cheap, or are they holding back, waiting to see what happens?
Yeah, it's an interesting question. We're starting to see the stepping up part, but this scenario, none of us have had to go through something like this, let alone private equity. And so private equity has been trying to figure out, how do we buy businesses when we cannot meet the management, we cannot meet the vendor. I think all of us have been surprised by how well technology has worked overall, but there are limitations, and I think we're starting to see where there was a dialogue pre-COVID and maybe a process was cancelled because of COVID, that people are happy for those to be restarted again, and done virtually. And then obviously with lockdowns being eased, there is some ability to meet management teams from a socially distant sort of point of view. So we're starting to see coming back that the sort of initial couple of months of the crisis, managers are very much focused on their existing portfolio. So really focusing on the staff, making sure that the people are able to work from home. Then focusing on the cost structures. Has the company got enough liquidity to endure this crisis, and stress testing that, and making sure they're in early dialogue with banks where something needs to be done, where there needs to be some form of covenant cure. But we've not really seen an awful lot of that. We've not seen an awful lot of managers calling to help support the existing portfolio. The portfolio's actually been reasonably resilient. But yeah, as we move into the second half of the year, I mean, obviously the M&A activity has dropped considerably, but we do expect that private equity managers will be very focused on making new deals.
Sure. Okay. Cool. All right. Well, we could go on, but let's open up some questions. So there's one on the screen already that is probably quite a hot topic. Charging. So yeah, can you just explain how your fees on the fund work, and then how the fees work with the underlying LPs, please?
Yeah, no problem. So so firstly, on our fee, I mean, we have a flat fee of 95 bips on NAV. We don't have a performance fee. I think we're one of the only ones, if not the only one, that doesn't charge a performance fee in that regard. But then how it works with the funds is that typically they charge a fee somewhere between 1.5 and 2%, and they have the ability, their performance fee is really based typically on the fund outperforming an 8% hurdle. So, the investors, i.e. the trust, get their money back plus 8% per annum, and beyond that, any profits are split 80 to the investor, 20% to the private equity manager. So it is a lucrative industry, private equity. I think we all realize that, but we're talking about net returns, and that's what we should be focusing on. the performance of the industry has been very, very strong indeed for a very long period of time.
And then, well, are you in a position to negotiate fees down, or is that something that it's just not worth doing?
I wish we were, because we're picking very institutional and high-performing managers. Typically, they have the leverage, so to speak, and we've not really seen private equity fees being touched. Other terms, yes, there's been some movement, but really in terms of fees, the sort of the historic 2 and 20 model that private equity is famed for has endured. Lower performing managers, yes, you've got an opportunity to maybe do something a little bit different, but in terms of the best names, that the fees aren't moving.
Okay, cool. What was the idea behind introducing co-investments to the portfolio, and how many do you think you might have, or how big a portion of the portfolio might it be?
Yeah, so co-investment is something that we as a manager have done for a number of clients for many, many years. I think we made our first co-investment in the early 2000s. We run co-investment fund, for example. We have people in our team, a dedicated team of around 6 individuals. The head of co-investment, Colin Burrow, used to work at Bridgepoint, one of the sort of marquee mid-market private equity firms. Another colleague of ours used to work at Sinben, one of the large private equity leaders, shall we say. So we have that experience there, and I think historically we always thought that Slepit was a fund-to-fund player. It was a cleaner message, and that's the strategy that we should take. We've seen our competitors over the years really double down on co-investment. Now, to be clear with co-investment, I talked about the fees on the funds, but co-investment typically doesn't have fees, nor performance fee. It's no fee, no carry is what they say in the industry. And so there's an opportunity there if you select right for you to outperform funds. And we've seen that through a very long bull market, that the performance in co-investment has outpaced the funds because of that fee element. So, given our competitors were doing it, given people were focusing more on fees, etc., we thought it was the right time to bring it in. And it allows us to manage our cash better as well, frankly, because co-investment gets called up front. And so it gives us some advantages there as well as in terms of performance. So we've been cautious around it thus far. We've made 2 co-investments. We briefly discussed them, Mademoiselle Desserts and Action. We have a limit set by the board of 20% of NAV. And we think about it as we make a co-investment of around 1% of NAV. So our portfolio really, we feel, will be somewhere between 10 and 15 companies, so quite diversified.
Okay, cool. Are there any other questions for Alan? Just email me, or here we go. So there's some skepticism over current NAVs and the lags involved in keeping these up to date. So how frequently is the portfolio revalued, and are NAVs likely to fall?
So private equity valuations typically occur on a quarterly basis, and we've just received the March numbers through in the last few weeks. That saw an overall quarterly movement of negative 12.5%, excluding the effect of foreign exchange. That was actually a tailwind, so it was just over 8%. And that was expected given what was happening in the markets at that point, and the fact that private equity valuations are typically pulled together by taking the earnings and applying them to a basket of market comparables. So the next one will obviously be at June now, we've got this interesting dynamic at June. I think when we were doing our modelling, a few weeks back, we always thought that March and June would be, both negative movements. Given what's happened in the market since, and the fact that a lot of private equity managers were essentially kitchen sinking the March valuation date, applying bigger discounts to the market comparables, anticipating what the impact that the lockdown would have on earnings, we might see a reversal of some of that. I'm not 100% sure, but it's very difficult to say right now. And June is very much in the air. We're hearing positive noises. It's very early on, and it's just flash numbers. But I think that my gut feel right now is that June won't be down like March was. But it's about this sort of offsetting between the impact on earnings and the rise in market comparables between March and June.
Yeah, okay. And that's my thinking too, actually, is that some of the share price falls that happened in the private equity sector were a bit overdone. But we shall see. Just to explain, because somebody's asking, so co-investments or direct investments is, instead of investing through the limited partnership vehicle, it's investing in the company directly, but normally alongside a private equity manager is doing the same thing. So that's why the co-investments. Just answer that one. It's an interesting question. So Alan, which equivalent trust do you envy or see as a major competitor?
Oh, I don't envy any of our competition. I think we've got the best trust, but I would say that, wouldn't I? I think we always look to, to understand what ICG Enterprise, Pantheon and HarbourVest are doing, really. The way I look at them is that probably ICG are the closest to what we do, but again, a little bit more global, more focused on I guess ICG products than perhaps the broader products. I don't know. I don't follow it too closely, but I'd say they are probably the closest in terms of, if you're looking for geographic and sectoral exposure and probably size as well. I think in terms of Pantheon and HarbourVest, I mean, they're the two excellent trusts. I would say that the overarching comment I would make is, I think the private equity trust world, in terms of fund of fund anyway, I think is very high quality these days. I know the market perhaps remembers the global financial crisis and some of the negative stories that came out of that, but all of our balance sheets are in very strong positions relative to the global financial crisis. And I think Pantheon and HarbourVest give that more diversified, high number of names. Probably they're more global than we are. They touch in different areas, like perhaps real assets and some, I think perhaps one of their cases and venture capital. So it's a bit more of a wider basket of private equity opportunities. I mean, we respect them all, frankly. And yeah, I think overall you see the discounts in our space. It's for me, it's very hard to justify them, but as I say, I'm very biased.
Yeah, no, I understand your frustration. This is an interesting question. I suppose we're talking about, so when you're selecting which funds to invest in, how do you judge the quality of the deal flow that the managers are getting?
So the deal flow is important, but it's probably worth answering this question more holistically. Like, what do we look for and what have we been looking for some time? So the key overarching things I would say, would be, we look for managers that have endured, the cycle, that have come through the global financial crisis, for example. They may not have performed particularly well, but they have made significant improvements to their model on the back of that. So having scars, I think, is very, very important when you're backing people, that, they know what bad looks like, as well as good. But look, thinking about the manager more, technically, what we look for more and more is specialism. So you can see that in our latest commitments. We've committed to HG, for example. Obviously, investors can get exposure through their trust, their manager that we respect and rate very highly indeed. Software specialists really know that space. Having a deep knowledge in a narrow area, I think, is more and more important as private equity becomes more competitive. So we look for that specialism. We look for managers that can create value over and above the management plan. You know, there's a number of managers in our portfolio that have essentially mini in-house consultancies. Triton, for example, based in Germany, in the Nordics, it has an in-house consultancy called Westpark, has over 50 people that can really create value by helping companies through, you know, come out of a corporate carve-out, helping them with their sales, pricing strategies, procurement, you know, a number of different ways. So you're not just relying on management and putting a bit of leverage. You're looking to create value more holistically. And then I would say we've looked for managers that can build recession-resilient portfolios. So you see a number of those, like Cinven, for example. As I say, it's been an incredibly long, strong period of time for the market, and I think most of our managers could see something was coming, and they were positioning themselves for a recession, and I think our portfolio will reflect that. In terms of sort of softer things that we look for, we look at the culture of the team. That's really important to us. It's important to know the manager well, the quality of the team, the depth of the team, their ability to source deals, their IC construction, their investment committee construction, ability to create value. And then obviously we'll look at the track record as well. That's important. But for me, it's really essential that you re-underwrite the manager every 3 or 4 years when they come back to market, because private equity individuals can earn a lot of money, and that can change behaviors. And, you know, deal makers that were previously so motivated and active can become inactive very quickly. So it's important to completely refresh your view every 3 or 4 years. But in terms of pipeline specifically, I mean, you know, we will look at that, and it's important, but it's more those broader factors that I've just mentioned.
Okay. There's one point we haven't talked about really is what's the sort of split portfolio by age? And specifically thinking about this money that was invested in 2019, are those deals now looking expensive, that they were done at expensive prices?
Some of them are, but some of them are not. I mean, if you look at the software market, for example, and 17% of our portfolio is to tech, then you know, the multiples are pretty much where they were tail end of last year. So it really depends on the sector. In terms of the maturity of our book, just trying to get it here, I think from memory, over 45% of our book is in assets that have been held for 4 years or more. So very much ready for exit and being an exit candidate. And then it's pretty balanced years 1, 2, 3. Beyond that, sort of, you know, we tend to try and invest, you know, roughly, well, it's hard for us to do because we're committing to funds, so it's really in the manager's gift, but it's roughly a sort of 15 to 20% per year. So yeah, some of those assets, I guess, will be looking reasonably expensive, but at the same time, I would again point back to the fact that managers have been more focused on recession-resilient businesses. For example, you may have read about, I think it's ThyssenKrupp elevators in various publications. That was a corporate carve-out from ThyssenKrupp of their elevators business by Advent and Cinven. They paid a pretty price for that, and if they were buying that today, would they have to pay that price? Probably not. It maybe be a turn or two cheaper, I think. But equally, that's a business that, you know, was still elevators need service, and they were continuing to service these elevators throughout the COVID crisis, even when there was the lockdown in China. The Chinese elevators were still being serviced, even in China, during that period. So yeah, that's just part of private equity investing. Sometimes you're going to buy the peak of the market, sometimes the trough. But for me, it's a long-term asset class, and that's the way you should think about an investment.
In this you haven't got all your eggs in one basket either, which I suppose is the thing. You've got a spread of things. Your US office is in Boston. Does that give you a bias to East Coast deals rather than West Coast in terms of the exciting software stuff in the West Coast?
Certainly, from my experience, there's no bias or home bias. I think the East Coast has been for some time, a very fruitful market. We invested in are committed to a fund run by a company called, or a private equity manager called M South. They're based in Atlanta. We committed to Great Hill, which is a technology specialist in recent times. To Onyx as well. They're not. I think they're actually based in Canada. From memory, I might be wrong there. So I mean, they're scouring the market. They're on the West Coast quite a lot, and we actually do have a separate venture capital team that they coordinate with as well. So I wouldn't worry about us sort of missing any trends. I mean, the US market's very competitive. You've got to be on the ground, both East Coast and West Coast.
Okay. And maybe just to finish up, would you, I suppose I'm paraphrasing this question, but would you say to anybody it's worth using Standard Life as a sort of one-stop shop for private equity exposure? Or would you think it's better to diversify across a number of funds?
Slightly loaded question. I personally invest in this trust, and I don't invest in the other trusts. There's obvious reasons for that, but I think if you're looking for predominantly European focus and with a little bit of the best from the US, then you have this enormous diversification of companies and sectors. So that gives me personally an awful lot of confidence, that I can invest in this because, and this alone, because of that diversification. So it's a very completely on the home side, but I think you can. But I think at the same time, you should be aware that our focus is mid-market and our focus is mainly Europe.
Cool. Okay. Well, thank you very much, Alan. That's really helpful. I think we're too long, but I say so. Thanks to Alan, my guest, and thanks to everybody who listened in. Property conferences on Wednesday, and we had 5 property companies presenting at that. That seemed to go quite well. We had quite a big attendance. And there's another one of those next Wednesday, and then I'll be back on Friday as well. And then we are getting closer to the date of our COVID-19 conference, which is on the 20th of July. So thanks to everybody, and I'll see you next week.